Billionaire bond kings dire market warning. In a recent interview about 2 weeks ago now, billionaire bond king Jeff Gundlach did a interview, and it was just fantastic. And he was interviewed by David Rosenberg, and I suspect, well, actually, I know where Rosie's opinion on inflation and interest rates and asset prices, etc., are heading. And Jeff has a different view. And in fact, what I want to do is I want to do less talking in this video, because there's a 20-minute clip from this interview, and it's a long interview, so I'll put the full interview in the link below, and I highly recommend you guys watch the whole thing. But I just want to share 20 minutes of Jeff's outlook, where he sees things going in the next 1 to 3 years and over the rest of this decade. And when you listen to him, you'll understand. By the way, I agree with everything that he says and his outlook. And you'll understand why I'm invested the way I am, why I am bearish certain asset classes like highly leveraged asset classes, why I want real assets, what I think about the 40-year bond bull market ending and moving into a bear market, and what that means for other asset prices and asset classes moving forward. And, you know, when Jeff talks, I listen, and I highly recommend you guys do as well. Other great investors that when they talk, I listen. Stan Druckenmiller, Jim Rogers, Mark Spitznagel, Felix Zulauf, Joel Greenblatt, Seth Klarman, Howard Marks, Peter Lynch. All the great ones. I listen, and when I listen to this interview with Jeff and this particular 20-minute period of where he sees the outlook going on markets, interest rates, asset prices, etc., the economy in general, and specifically the debt-based fiat monetary system. And that's why I've entitled this Got Gold and Silver. So go make yourself a cup of coffee, a cup of tea, sit back and listen to Jeff share his thoughts. And as I said, I'll put the link to the full interview in the description below.
What's your view on where are we going? We're in the and I'm not talking about 10 years, because who knows, but let's say in the next 1 to 3 years. Yeah. What's your view?
Well, to start off, I remember you just said 14% down to 4%. We're almost at the 40-year anniversary of the last big peak in interest rates. It was May 31st of 1984. And the longer-term treasuries were at 14%, and the inflation rate was at 4% and falling. And people were still afraid of bonds. They passed on a 10% real interest rate that turned into more than a 10% real interest rate, and that was the turning point for yields declining. And I feel like we almost have the exact reverse going on, where the policies that the government has shown its hand as being willing and able to execute upon suggest to me that we're going to have, in the near term, I think the inflation rate is not a problem. I feel like that there's more of a recessionary feel than an inflationary feel. But my fear is that the Federal Reserve will go back to their old tricks. And I think Jay Powell even said so kind of off the cuff in one of the press conferences a couple of Fed meetings ago. We need to reduce the balance sheet so that we can gun it back up again in the next recession, which indicates to me, sadly, that the response to the next economic downturn will be money printing and inflationary policies. And so I fear that in the next recession, I expect that inflation will go down, and I expect that long-term bond yields will go down. But then I think everyone's going to get caught, because they're going to print money, and they're going to gun the balance sheet again, and they're going to cause inflation again. And I think they're stuck with this because the interest expense problem is getting very real. Interest rates, Japan has more debt as a percent of GDP in the United States, but their interest rates are nearly zero. So they don't have a problem. Our debt is very large as a percentage of GDP and on an absolute basis, and yet our rates are up 500 basis points. We have trillions and trillions of dollars of treasury bonds that are maturing. And this calendar year and the next 2 calendar years are 17 trillion. And many of them have coupons of 50 basis points or 25 basis points. 10-year treasuries at 1 basis point, at 1% rather. And these are coming due. And if interest rates are where they are today, the interest expense is going to start turning into one of the largest budget items. It's already surpassed the official military spending. And higher for longer means that these maturing bonds are going to be priced at 400 basis points or 300 basis points or 200 basis points higher than what's rolling off. And I spoke at Jim Grant's 40th anniversary conference back in October. And as luck would have it, there was a big newswire story about how Stan Druckenmiller was sounding the alarm on the interest expense, but he was using the CBO data. So he said, oh, it's going to be, like 30% of tax receipts by 2040 or something like this. And this is a problem. That's not even close to accurate because the CBO's estimates are highly optimistic. They assume real growth all the time of 2%. I can't blame them for that because they make multi-decade projections. So how are you supposed to do business cycle? So they just throw in the towel, and I can't blame them. It's just going to be 2% real all the time. But they make 2 assumptions in there that are really specious. And one of them is that the interest rate is going to be 3%. Well, it's already has a 4 handle across the curve and a 5 handle on the T-bills. So that's not a good assumption. And they assume that the budget deficit will be something around 4% of GDP. Well, it's already 6. The Biden administration predicts it's going to be 6.1 next fiscal year. And of course, that assumes no recession. When a recession comes, you add percentage points of GDP onto the deficits. In the old days, it used to be 4%. In recent recessions, it's been, well, the COVID, we'll throw that one out. It was 20% of GDP, but that was the money printing. But 9% in global financial crisis. So let's just say it goes up 6%. That means we would have a budget deficit of 12% of GDP. And if the interest rates aren't the 3% they assume, but they're, 6, because people don't like the inflationary response to the recession, we're going to end up with, not like Stan Druckenmiller quoting the CBO, we're going to end up with something like the entire discretionary budget will be, the interest on the debt will be that size, the entire discretionary budget by 2030. So we're in the end game here for this debt finance scheme. And I believe that the way to fix all of this will make it so that we're in a better world going forward, maybe in the 2030s, because we're not going to be able to borrow anymore. We're going to have to run a sound economy. That's so outside of the psyche of consumers today. Consumers today are borrowing money like crazy at 23% interest rates. I remember when I got my first credit card, it was from Sears. And I couldn't believe it. I filled out the application, I got a credit card, and that was like my coming of age. I'm verified now. I'm a real adult. I've been, all that, it's just a trick. It's a trick to make you sort of waste your money, get yourself into a debt trap. And we've done that across the entire society. And I worry about how we're going to deal with this interest expense, because we have over $210 trillion of unfunded liabilities in the United States. Unfunded pensions, Social Security, Medicaid, Medicare. And the trustees of Social Security, using CBO estimates, say Social Security runs out of money by 2034. There's another report that says 2032, but it assumes no recession. So they're going to run out of money in the 2020s if there's a recession, which I certainly believe there will be by 2030. And the Medicaid, Medicare trustees say they're out of money in 2030, no recession. So they're going to run out of money like before the next presidential election after this one. So what are we going to do? I've got a sort of a radical idea, and I'm not predicting this, but it's something that I've started to implement. And that is that I don't like taking any risks that I don't get paid for. And if I can eliminate a risk at no cost, I want to do that. So I've got this crazy idea that I want to buy only the lowest coupon treasuries, zeros if possible. Because if I have a very low coupon treasury, I don't have to worry about being restructured. I worry that the federal government might be forced to restructure the treasury debt. People say that's impossible, that's a contract, it's illegal. And I say, well, don't you remember the mortgages back in 2007, 2008, 2009? It was illegal to modify those mortgages. It was in the prospectus of trillions of dollars of mortgage-backed securities that these mortgages cannot be modified. But they did it. The Federal Reserve Act of 1913 says the Federal Reserve is illegal to buy corporate bonds. In 2020, they started doing it. They didn't have to do very much because just by doing it, the market repriced aggressively because they said, well, the Fed's got an unlimited balance sheet or perceived to be a huge buying power, so they can right this market. And so that happened. It's illegal. It's unconstitutional to cancel student debt. But $7.7 billion of student debt was canceled yesterday in one day alone. So the fact that something is viewed to be a contract doesn't mean it won't happen, because it's been happening with regularity over the last several years. So what if, and I'm not predicting this, but what if the Treasury says, hey, we've got all these bonds out there, and some of them are quite old, and some are paying 4%, 5%, 6%. We're in a jam. So what we're going to do is every Treasury bond that has a coupon above 1, we're resetting the coupon to 1. And every bond that has a coupon below 1, we'll keep the coupon as it is. And if you own a 6% coupon 20-year bond and it gets reset down to a coupon of 1, I'm not predicting this will happen, but it might. You're going to lose 50% of your value at least. So buy the ones that have the lowest possible coupon because they yield the same. People haven't figured this out yet, that there's a risk.
But when you consider who are the biggest holders of bonds are like the pension funds.
Oh, I understand. It's a disaster. It's a total disaster. But that's what happens when you have no options. You know, it's sort of like when you first get a sore throat and you think you're getting a cold and you try to convince yourself that no, it's not real. It's just just a little scratch, and it takes you all day long. And finally, by 3 p.m., you're like, resign. Yeah, I got to admit it. I'm sick. I got this cold. I'm going to be sick for 10 days. People like to put off bad decisions, difficult decisions. But the danger is they put them off so long that the options are limited. People say to me, well, what can we do about these unfunded liabilities, the value of which is greater than all the financial asset value in the United States? What can we do about these? And I say, you can get somebody smart in Silicon Valley to create a time machine, and we can go back in time to 1982, and we'll start over, and we won't do this again. It's like when I used to take taxis, when I would travel to cities, the taxi drivers, if they say, well, what business are you in? Investment guy. Well, I want to retire in 8 years, and I've got $3,000 in savings. What can I do to get till I can fund my retirement in 6 years? And I get a time machine because it's too late. And unfortunately, I think that the scheme that we've used, which has gotten more extreme with every recession, basically, it's a dead end. And it means running a negative interest rate and causing inflation is in a response to the next recession. And that's why I think the dollar is going to go down in the next recession, not up. My entire investment thesis for the last couple of years, and it's been working quite well, is fundamentally around this dealing with this idea that what we think we know from the 40 years into 2021, 2022 is informed by falling secular interest rates. Junk bonds didn't default. They would refinance. The spread might have been wider, but yields fall during recessions, and junk bonds, shaky companies, instead of defaulting, they could refinance and buy some.
Those are callable bonds, unlike treasuries. So let's say.
Well, I'm just saying that they never matured. So with interest rates where they are now, junk bonds were issued at coupons of 3.5% in 2021. Those will never be refinanceable. So those companies, if they run on hard times, they're going to have to default. So I believe in rising interest rates, default rates will be higher than what we've experienced. Now, counteracting that is there are some good things about the junk bond market. It's more secured than it used to be. It used to be largely unsecured, and there's more secured sections of it. CFOs are pretty smart. They pushed out maturities. We don't have a maturity wall coming this year, not really next year. So that's good. But at the same time, we've got this bank loan market, which is very diversified. And what I mean by that is the CCC bank loan market looks like a disaster to me because these companies are borrowing at a very high rate. They started out at 4, and some of these companies are at 10.
What about the private debt market?
I'm so glad you said that. I say this, every talk that I've given in the last 18 months, private credit comes up. It's usually the first question from the audience. I just did an event at CIBC. First question was private credit.
Was Gerard Cassidy there? Because he was on my webcast last month.
I don't know.
Yeah, well, he's their financial analyst, like the guy's one of the best in the business, and he thinks the bubble is not with the banks, the bubble is with private credit.
Oh, I think that's right. In fact, private credit it's had a good run for a couple of years, and it's now the run has been so good that it's inferior to public credit. My head of my leverage finance team, Robert Cohen, did a great presentation for our clients a couple of weeks ago, where he went through a comparison of the public debt market and the private debt market, and there is no factor on which private credit looks better than public credit at the present moment. It's riskier. It doesn't have the same reward. So it's the absolute worst. It's the anti-Bud Light. It tastes lousy. More filling.
And that's probably the greatest risk. That's where you get to a pension fund crisis.
Well,
right?
let me go. This is a topic that I've been talking a lot about this week. Private credit is always a boom when public credit is unjustifiably expensive. And I put that as the year-end 2021. Year-end 2021, anybody with a brain knew that inflation was not going to be transitory and it was going to go up well above that 2% number. And bond yields in treasuries were at 1 or lower. That's a horrible investment. It's not even an investment. It's just a thing that you own because you're too dumb to sell it. And obviously, the inflation rate went way, way up over that time period, and the Fed called it transitory and all that. But if you know that interest rates are going up, you don't want bonds. You don't want public bond credit. And if you know interest rates are going up and the PE on the S&P 500 at the end of 2021 is 25, you don't want equities because the discount function is going to crush you. And that's exactly what happened. So what do people do when they don't like the outlook or the valuation of the stuff they think they know how to analyze and evaluate? Well, what they do is they say, I don't want bonds. I don't want the S&P 500. So what am I going to invest in? And they say, oh, I know. There's a SPAC thing. It's like this blind pool. I have no idea what they're going to do. Or I can put it into a locked up private credit fund and just say, here, just let me know what the result is down the line. And I'm all locked up. And of course, private credit's always sold on the scam of Sharpe ratio because it's not marked to market properly. When stocks go down 50%, the private equity goes down 20 just because they're not marking it. So when it goes back up to where it started, the stocks show, more than double the volatility of the private credit, but it's just a scam because they're just not marking it to market. So you're just fooling yourself. So when people find themselves not liking traditional bonds or the S&P 500, they say, I'm willing to go into your SPAC. I'm willing to fund your drawdown locked up private credit fund under one condition. You don't tell me what you're doing. Because if you tell me what you're doing, I'm going to get scared because I'll be able to because there's nothing inherently cheap about the private credit. It might have been cheaper than public credit. I think it was back then, and it's had a really big run. But I saw a Newswire story this month that really opened my eyes a lot. And that was Harvard University with its $50 or $60 billion investment endowment portfolio, which should be taxed, by the way. All these endowments should be taxed. They $50 or $60 billion, they couldn't pay the bills. They couldn't pay the maintenance, the lights on, the salaries, because they're so illiquid. They're so locked up in all this stuff. They had to go to the market and try to borrow $2 billion to fund ongoing operations. And the market wouldn't accept it. They were only able to get about 1.3, 1.4 billion done, but that's still a lot. And they're not alone. This is one of these environments where, because people didn't like the analysis outcome of the stuff they understood 2.5 years ago, they went into the stuff that's locked up and illiquid, hoping that that would solve their actuarial targets. And I have a feeling that Harvard is not alone. I mean, there's never one cockroach, and I have talked with so many clients and so many high net worth investors that are very illiquid in their basic portfolios. And I think the theme of this moment is that you need to be getting liquid, because there will be opportunities. A recession is going to come. Whether it's going to come this year, I think so, but I don't know. And there's certainly many indicators that support that, but the mapping with all of the volatility on the money printing and everything I've already addressed, that volatility has been difficult to predict, and the mapping hasn't really been traditional. But I think that's going to happen, and that's when you want to buy the illiquid stuff, when it's down. I remember in 2008, I had distressed funds going on in the bombed out residential mortgage market, and they were so cheap. It's just unthinkable. There's been a few moments in my career where things were so cheap that if you tell people about it, they won't believe you, because it's so out of the context of their own experience. But I had a presentation that I could prove to people, and I mean prove, that a certain mix of prime credit rating mortgage-backed securities that were trading at 45 cents on the dollar with fixed coupons of 6, that these securities, the worst possible case was a 24% IRR for a number of years. That's the worst case, assuming massive defaults, worse than actually happened, horrible recovery rates, 24%. And I met with the Stanford University endowment. And the fellow there, I went through it, and he said, I can't argue with your logic. You're right. It looks like 24% is the floor. It ended up being more like 35% IRR when the outcome happened. But he said that the problem is I have no money. I said, what? It's a huge endowment, right? He says, we're no money. We're actually defaulting on the commitments that are being drawn down, because every lockup fund was drawing down capital because everything was cheap in 2008, 2009. He says, I can't. I said, well, just 10 million. Put 10 million. He says, I don't have $10 million. I have no money. And we saw people who were committed to private credit funds in 2008. They hadn't even funded them. They called the capital and they didn't have it. And so they sold their commitments at 30, 40, 50% discounts. That's what happens when Jim Grant wrote the book, The Problem with Prosperity. And that was actually about pre-credit crisis. And he turned out to be quite right about that. But I think there's problems with any kind of political economic system that's not fundamentally sound. And borrowing your way to prosperity never works. And yet the mantra of our society, and I would say the developed world, is that is just fine. It just doesn't matter. And we're at the point where we're in the last mile of one thing. We're in the last mile of this debt-fueled situation. There's the saying in basketball, when you think a three-pointer, nothing but net. And I say this economy is nothing but debt.
Well, there you go. I think wise words from Jeff. And, I agree with just about everything that he said there. And it's why I'm positioned my portfolio into certain asset classes. I'm happy to be patient, happy to wait. Things always play out, take longer to play out than you think. His concern is over, I guess, the whole the debt-based fiat monetary system. The bond market, deficits, inflation, etc. He even used the word endgame. And so when we're talking about endgame, and we are getting closer, and no, this is not people who've been saying this for 20 years, 30 years. I know that's been the case. But, these guys have not been saying that. But now they are. And I think it's wise if we pay attention and listen. So anyway, do you guys have gold and silver? Or how do you guys see this play out? Do you agree with Jeff? Do you disagree with Jeff? What do you disagree with Jeff on? I'd love to see your thoughts and opinions in the comments below. If you like this video, do us a favor, hit that like button. If you haven't subscribed yet, do so. Hit that notification bell. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.